Hello and welcome back. This is David from the Personal Finance Squad. We just finished with the beginning of Chapter 6, Flexible Spending Accounts, otherwise known as FSAs. What we covered in here is the basic setup of a plan year where you can take money put aside pre-tax so that you can pay for medical expenses that aren't covered in your general plan. So what we need to do now is section 6.1, where we want to go in and actually create that plan and determine how much money should be set aside. Okay, so what we talk about here is the period, right? The coverage period. So we want to say it's at the time the plan year ends. So we talked about the plan year, meaning it could happen at January, it could happen in another month if a company has a fiscal year. So just look at it, what you care about is when is the plan year? And that's the cycle you're looking for. So we're going to assume that we're just going to do this from January to December, and that's the most common you're going to see. Now here's another piece of information. If an employee leaves the company before the plan year ends, the FSA plan ends upon termination. But you will get your money back. So if you have money in that account, say $300, and you're not there anymore, that money does come back to you. Okay. So here's some good information, just things to think about here as we go through this. But the sole point of participating in this plan is it reduces taxable income. That's all it is for. Because no matter what you do, for all the expenses that at least you know of that you're going to pay for, you're going to pay for them anyway. What we're doing is to try to put more money in your pocket. So here is one caveat to think about. And this is very important when we make decisions here. If, in fact, I'm going to stop inking and we're going to push everything down here a little bit. This is the challenge and the difficulty of doing an FSA, and that is right here. Money inputted into the FSA will be forfeited if it's not spent in the plan year. So just a quick loose example, let's say you decide to put $300 in from January to December. And then you say, actually let's make a little bullet here, and then you say, you know what, I find out that in December I've only used $260. So what happens? You're going to lose that $40. So we say the plan expires, and that means forfeit $40. Now, in this loose example, is that a lot of money? No. But again, we don't like to give money away to anybody that we don't have to. So, in other words, basically it is, as written here, a use it or lose it rule. We are going to map out, like we do with everything else, in a year cycle to find out what is the best path. Now, granted, you're going to see here that we don't have a whole lot listed here. This is something that's really, you're going to have to go figure out. If you're like a student taking this class, stuff like here might be something more feasible to know that are common, but, and maybe not. Maybe there's procedures you've had, or what you're going to need to do is speak to your parents and find out the kind of things they may have to pay for that's not covered by insurance. And you certainly go do some research on the internet, for example, as you build this out and just come up with a hypothetical scenario. And then for those of you who are in the working world already, you pretty much have a good handle on what things that you pay for. But for purposes of this exercise, we're going to keep it small so it's easier to understand and see. So the way we're looking at it here is Jasper's pretty healthy. He hasn't had any past medical things that are outside the norm, so that's good for him. So therefore, he is only going to put the basics on here. So we can see here that we have some common things. Jasper's a 35-year-old man. We're going to assume he's had some really good health, and he is assuming that he just wants coverage in just the typical areas for him right now. Co-pays. It's money that you have to pay no matter when you go. It's just a fee, so $30. Deductibles. Deductibles are similar. We talked about that in auto insurance, right? You have to pay up front before you get coverage on something else. So if you hit a car, you have to pay $500 to get it fixed if it's your fault. In this case, with a deductible, we'll get into more into medical plans at another point, but you have to pay this $200 first. You have to meet this first $200. So it's the same thing. So you have to pay out $200 first before you receive coverage. Now, just so you know, it doesn't mean that you won't get coverage per se, because you might get billed afterwards, but sometimes, you know, you're going to see offices that want money up front. So that just depends on your situation. But the general idea is the same thing. Prescriptions, very common as well. There's tiers in medical plans that only cover certain amounts of drugs. So you might have a tier 1 drug that's $40, and for, let's say, Nexium or something like that for a heartburn, but they're only going to cover 30 of that, so you might have to make up the other 10. Those are things that are examples of how Jasper would have to pay. So using our grid as normal, we can take the frequency by the amount and do the basic math. And we can see here that 12 times 30 is 360, so he's planning on going to the office 12 times once a month. That's actually quite a bit, but maybe, you know, he's got a child that goes to the doctor a lot, and that's very common because kids catch colds in daycare and they just get things from other kids in class, so that's what happens. Deductibles, we talked about that, so that's only $200 because the frequency's 1, because we don't know how often you're going to go to pay that off. It just depends on the amount of visits you have. So you have to understand that, right? So if you go to just as one more side note, if he goes to the doctor and he pays $30 for copay, right? Well, he can apply that in most cases to the deductible. So that would be $170, and then if it's just a general office visit, for example, let's say it's $75. So that takes off another $75. So at this point, his deductible remaining is $95. So he's paid out the first chunk of money, and that's how deductibles work for medical. Okay, I don't want to get off here too much, but we can see right here that the prescriptions add up to 158, and this comes to a total of 718, and averaging a $59.83 cost. So of course, here's our math as usual. We're going to round it to 60. It's cleaner and easier to work with. And then because he gets paid bi-weekly, rounded to $28. So that's his cost. So on the whole, especially for what Jasper's making, it's not a lot of money. And then when we talk about changes to the line item, this is just a snippet. Expenses list in his budget. His healthcare was at 30. So 30 was the previous. But now that he knows that he's going to get $60 a month average for his cost, he's going to change this. He's going to bump this number up. Okay, so that's going to end this section, and we're going to get into how this shapes up into the budget, where we see the benefit of paying for this pre-tax. So thanks for joining. We'll see you in the next video.